Did you know the global Forex market moves over $7 trillion every single day? Have you ever wondered how traders even begin to understand it all? In today's lesson on Forex currency pairs, the building blocks of Forex trading, we'll break down how these pairs work and how traders aim to profit from them.
Welcome back, traders. Picture this. We're in a buzzing trading cafe. Wall-to-wall screens flash with currency pairs and price movers. Traders huddle over charts and sip their coffee. The energy is alive and constant. And in the middle of all this activity lies today's focus, the very foundation of Forex trading: currency pairs. Before we dive deeper, let's quickly refresh what we already know. In a pair like the euro over the US dollar, the first currency, the euro, is called the base currency. The second, the US dollar, is the quote currency. And the exchange rate tells us how much of the quote it takes to buy 1 unit of the base. Knowledge check. Let's see what you've learned so far. If you exchange 5,000 US dollars into Japanese yen, how many yen would you get? Is it A, 142.5 yen, B, 35.09 yen, C, 35,087 yen, or D, 712,500 yen? You have 10 seconds. The correct answer is D, 712,500 yen. Here's why. If 1 US dollar equals about 142.5 Japanese yen, then 5,000 US dollars multiplied by that rate gives you 712,500 yen.
Nice work so far. If you want to make these concepts stick, grab your free Quick Start guide. It's packed with charts and definitions to help you review. And for the best experience, try watching on a bigger screen so you can really see the details.
Not all currency pairs are created equal. They differ in 3 important ways. First, liquidity, how easily they can be bought or sold. Second, trading volume, how much is exchanged every day. And third, behavior, the unique way each pair tends to move in the market. Currency pairs are grouped into 3 main categories. First, the majors, the most traded pairs in the world. They always include the US dollar. Second, the minors, pairs that don't involve the US dollar, but include other strong currencies like the euro, the British pound, or the Japanese yen. And third, the exotics, pairs that combine a major currency with the currency of an emerging economy. Major pairs always include the US dollar, paired with one of the other 7 major currencies: the euro, the British pound, the Japanese yen, the Australian dollar, the Canadian dollar, the Swiss franc, or the New Zealand dollar. Together, these majors account for about 80% of all Forex trading volume. And the single most traded pair is the euro over the US dollar, which makes up nearly 28% of daily activity. Minor pairs do not include the US dollar. Instead, they involve other strong currencies such as the euro, the British pound, the Japanese yen, or the Australian dollar. Examples include the euro over the British pound or the British pound over the Japanese yen. Minor pairs are traded less than the majors, but they're still widely used by traders around the world. Exotic pairs combine one major currency with the currency of an emerging economy. For example, the US dollar over the Mexican peso, or the US dollar over the Turkish lira. These pairs are less liquid. They trade at lower volumes, and they often come with much higher volatility. Knowledge check. Here's your challenge. Categorize each currency pair into the correct group. You have 10 seconds. Here are the correct answers. The euro over the US dollar is a major pair. The British pound over the Japanese yen is a minor pair. And the euro over the Polish zloty is an exotic pair. Understanding the volatility of different currency pairs is crucial for trading success. Major pairs, like the euro over the US dollar, usually move less dramatically. Exotic pairs, on the other hand, can swing much more sharply. This difference directly affects your level of risk, your potential profit, and how you should set your stop-loss orders. Knowledge check. Trading with volatility. The euro over the US dollar chart shows small, steady movements, about 50 points in the last hour. Meanwhile, the US dollar over the Turkish lira has been swinging wildly with more than 1,000 points in that same period. A trader has 5,000 US dollars to risk across 2 different trades. Considering their different volatility profiles, how should the trader split their risk? Is it A, divide the money equally between both pairs? B, put the entire amount in the euro over the US dollar for maximum safety? C, put the entire amount in the US dollar over the Turkish lira for maximum profit potential? Or D, allocate a smaller portion to the US dollar over the Turkish lira because of its higher volatility? You have 10 seconds. The correct answer is D, allocate a smaller portion to the US dollar over the Turkish lira due to its higher volatility. Smart risk management means adjusting your position sizes based on volatility. With exotic pairs like the US dollar over the Turkish lira making much larger price swings, a smaller position helps control risk. For example, you might allocate $1,000 to the US dollar over the Turkish lira and $4,000 to the euro over the US dollar to balance your exposure. This difference in volatility directly affects your trading approach. With major pairs, you may need larger position sizes to reach your profit targets. But with exotic pairs, smaller positions are usually more appropriate because their wider swings come with higher risk. Let's recap what we learned about currency pairs and how they're categorized. Currency pairs always consist of 2 parts: the base currency, listed first, and the quote currency, listed second. Major pairs involve the US dollar paired with another major, like the euro, the British pound, or the Japanese yen. Minor pairs, sometimes called cross pairs, contain 2 major currencies but no US dollar. Exotic pairs combine a major currency with the currency of a developing or smaller economy. Each category comes with its own level of liquidity, spreads, volatility, and trading opportunities. And remember, volatility isn't just a Forex concept. It matters in all markets, especially the stock market. That's the foundation of understanding currency pairs, the building blocks of Forex trading. Good job, traders. Another lesson complete. You've now got the foundation of how currency pairs work and how they're categorized. Keep building your knowledge one step at a time, and remember, consistency and discipline are what turn learning into lasting success.
Great work today. Don't forget, you can grab your free Quick Start Guide to review the key terms and charts we covered. And if you really want to see the details clearly, try watching these lessons on a larger screen. We'll see you in the next lesson.